Welcome back to another edition of the Pocket Pundits podcast. This is our Q4 edition. I'm really excited for this one because it gives us a vantage point to sort of look back through 2025, talk about what worked, look at some of our predictions from Q1, and also equally exciting to have Strider Elass joining us again. He's the senior economist for First Trust. If many of you didn't catch our Q1 episode, it was actually our most viewed and shared episode. And so again, really excited to have Strider back with us today. Get a chance to talk a little bit about what you and I spoke about in Q1, looking at the economy, geopolitics, tariffs, inflation, AI, housing, right? There's certainly no shortage of topics we could get into,
No, there's not.
Really looking forward to this one. And thank you again for joining us.
Really great to be with you again. Look forward to getting into it.
Fantastic. Well, let's dive in. In the first quarter, Strider, you and I talked about how the health of the economy, what some of the data points were telling us. Then we had a nice shock in Q1 with the tariffs and the geopolitics certainly getting in flux. So let's start there. What are you seeing on that front? Are we sort of through the worst of it? Do we expect some more gyrations? What are your thoughts there?
Sure. So looking at tariffs in general, I think they have been fairly extreme, especially than what most people expected when Trump came in to the administration. A lot of people expected, as we did too, that he was going to use tariffs as a policy tool like he did last time. And the goal was to actually see tariffs come down across the board for all countries. And that's really what happened last time when he was president the first time around. As he started to raise tariffs, pretty quickly his rhetoric changed to, hey, look, this is actually a tool that we could use to bring in revenues to government. And so we saw effective tariff rates across the boards for looking at all countries combined go from about 2.3% in 2024 to the latest about 9.8%. So meaning if you're importing $1 worth of goods from some country, you're paying now about $1.10 to get that into the United States, where you were paying $1.02. But for some countries, it's even more extreme. So you think about a country like China, for instance. In China in 2024, it was 11% was the effective tariffs. Now it's over 40%. And so $1 worth of goods used to cost you $1.11 to get it into the United States from China. Now it's costing you $1.40. That's pretty extreme. And so all in all, if you look, no matter which trading partner you're looking at, all of our top trading partners, tariffs have gone higher than they were. And so what that's done is we've actually seen about $240 billion that has come in customs duties from all of these tariffs. And Trump looks at that as, hey, we're making all this extra revenue from these countries. But the reality is it's not the countries who are paying the tariffs. It's really U.S. companies and U.S. citizens through higher prices that are really on the hook for those higher tariffs. But that's the situation we're in today. Is it going to get worse? I don't know. I think the biggest problem for me is not even so much the tariffs, although I don't love the fact that we have all these tariffs. The bigger issue for me is really the uncertainty around the tariffs, because nobody knows, especially think about if you're a small and medium-sized business. Companies aren't making decisions for today. They're making decisions 3, 6, 9 months out. It takes months for whatever they want to produce to get produced in those countries, and then it usually goes on a ship for another month. And so if you don't know if tariffs are going to be 40% from China or if they're going to be 80% or 180%, it makes it very hard to make decisions today for 3, 6, 9 months out. And so I think a lot of companies have been hesitant just because they don't know what the exact situation is going to look like a few months from now. And that to me is still the biggest concern about tariffs in general.
One question I had, and you mentioned it, in terms of the consumer, are you seeing some of that pressure or the increase in prices showing up in consumer behavior or even sentiment?
Yeah, I wouldn't so much say we're seeing too much in terms of the aggregate numbers yet, but definitely I think who's impacted the most, I think, are those in the lower income spectrum, because it gets shared by everybody who's buying these goods and so on and so forth. And so those on the lower end have already been absolutely crushed from the higher inflation that we'd seen over the last 5 years or so. And they're the ones with no assets. Yes, everybody's been paying higher prices for gasoline and for food and other items. But the reality is that if you have the assets, your assets have appreciated so dramatically that that's more than offset the inflation that we've experienced in these other categories. And so I look at tariffs as a tax that hits everybody, but it really impacts those on the lower end, I think, the most. And that's to me where it's the most damaging.
Sure. How do you think that's influenced monetary policy this year?
Yeah, I think when you look at the Fed and what the Fed's expecting to do or has done so far, they've made it very clear that they believe tariffs are an inflationary force. Now, I agree that tariffs will raise prices for some goods, but the reality is that it's not going to raise inflation for everything. And what really matters for inflation is money supply growth. And when you take a look at money supply growth, 2020 grew by more than 40% over a 2-year period. That was a huge issue that caused the massive inflation that we saw. But money supply is growing about 4.5% year over year right now, which to us means that we're probably going to continue to see downward pressure on inflation moving forward here in the coming years. And so looking at the Fed's dual mandate, I'd say from a price stability perspective, I think things are going to be okay. We're currently sitting around 3%, and I think in the next year we'll see that trend further lower, not higher. On top of that, the other part of their mandate is looking at full employment. And when you look at the employment picture, I'd say that to me is a little bit more concerning here. And so the Fed needs to put more emphasis, I believe, on that side of it than on the inflation side of things moving forward here. And so will they cut in December here? The markets are saying no. Just a couple of weeks ago, it was almost a done deal. And now it looks like it's really up in the air. And I tend to think that they may wait and see a little bit here. Reason being is because we did have the government shut down. It did make a lot of the data not available that they like to see. There's enough private data that you can get a good idea of where things are. But if they're looking for any excuse to kick the can down the road a little bit further and wait, as we know from the minutes that just came out, they already were pretty wishy-washy between everybody, whether there was going to be a cut or not in December. It gives them good reason to push it a little bit further here. So we'll see, but I expect at least a couple more rate cuts into next year for sure, whether it's one in December and then another 2 or 3 next year, or 3 or 4 in 2026 and no more this year. Either way, I think we will see further rate cutting this cycle.
Yeah, and I feel like if 2025 is any indication, it's certainly been difficult, it seems, to sort of predict what the Fed's going to do. It seems like we started the year with a certain level prediction across, a number of the large institutions, and that's certainly shifted. But one area I wanted to ask you on, because you mentioned it, is employment, that being a key factor in the economy. In the last few weeks, we've seen some larger companies announce pretty significant layoffs. Some of it's been in the tech sector, some of it's in the telecom sector regarding employment. And I would also throw in, get your thoughts on the immigration side of things. What do you see happening there, Strider? Are we seeing some shifts happen? What are we not seeing in the data that you think is really important?
I think the biggest thing that's important here is when you're looking at what type of jobs are being created. And what's been really shocking to us, especially over the last 2.5 years or so, is that majority of jobs that are being created are really coming from 2 specific areas. It's healthcare and education, which is one area, and then it's government. And both of those are heavily driven by government spending. And in fact, if you look over the last 2.5 years, about 75% of all jobs that we have gained have just come from those 2 segments. So only 25% has come from everything else. And to me, that's a big concern, and something that I just think is just not really sustainable over the longer term. And so the fact that job growth has been slowing, especially recently, has gotten a lot of people concerned. But I'd say it's not something that really started recent. It's been a problem for some time with the type of jobs that are being created. But I do think immigration's having an impact as well, especially since the new president's come in with President Trump. He's been really for trying to get illegal immigration under control. If you actually look at border crossings and what's been going on there, they're now at a 50-year low, or 50-plus year low, after 3 consecutive years of the highest that we've ever seen in history. It's making a difference, and it's made a difference with employment too. If you look at native-born employment, so people from the United States, since January, that's up 2.7 million. If you look at immigration employment, foreign-born employment, it's actually down 1 million over that same period. So it is having an impact on employment for sure. In terms of all the jobs, different companies that are coming out with layoffs, I think we'll see a lot more of that. But I think it's also important to realize that every single month, the employment report that we get, that's a net figure. So last September, we added a little over 100,000 jobs. But the reality is there's a ton of churn that happens every single month. There's about 2 to 2.5 million people that are employed every single month, new employees, and then there's about 2 to 2.5, or a little bit less. So you have that positive net number that are fired or let go every single month. It's easy to focus on, especially when things are starting to look a little bad, that you're looking at all the layoffs, but you're not really hearing about all the hiring that's going on. There's a lot of churn that's going on. Net, I think we're still adding jobs, but I do believe it's going to continue to slow moving forward here as the months go on. And I wouldn't be surprised if it does turn negative at some point here.
One area of the economy I wanted to get your thoughts on specifically, because it's a big topic for, I think, everybody, in particular our clients, is the housing market. Obviously, we've seen a pretty significant run up over the last 5+ years in almost all markets, certainly here locally in Utah, but some signs seem to be pointing that that's slowing down. Obviously, we're in a more structurally higher interest rate environment, I would say. And so what are you seeing in housing? What do you think the outlook there is?
Yeah, I think a lot of people are starting to get concerned because home prices are up. I mean, over the last 5 years, nationwide, they're up over 50%, which has been incredible. And a lot of that has to do with inflation, but it also has to do with supply shortages that we've seen and demand, especially early on during COVID. But looking where we are today, home prices nationwide have been pretty much flat. They're up slightly, but nothing to get excited about. And so I think a lot of people are starting to think back to 2006, 2007. Are we at a tipping point where all of a sudden we're going to have a housing collapse because we've seen this big run up in home prices? But again, I think it always comes down to supply and demand. And the reality is that demand has come down substantially with these higher interest rates that we have seen, but supply has also been very, very low relative to where it should be. And a big reason for that is because, and I look at it as a huge benefit, is because when you look at mortgages outstanding, majority of those mortgages, 95% of those are fixed. And they're fixed at very, very low interest rates. In fact, about 50% of mortgages outstanding today are still fixed at less than 4%. And so if you think about it, why haven't inventories gone up? Well, a big part of it is because nobody's willing to sell their house. Why give up a sub 4% interest rate when you buy a new equivalent priced home where all of a sudden your interest rate might double or triple from where you currently are? It just doesn't make sense. And so, again, it's all about supply and demand balance. And I think supply and demand over the next couple of years won't get out of whack. I think if interest rates come down a little bit further, that'll entice some people to want to sell their homes, so inventories will go up. But with that lower interest rate, I think it's going to bring more demand back. So I don't think we're going to see a big supply increase or a huge demand increase either way. I think they're both going to go pretty much hand in hand moving forward here, which makes me not too concerned about housing. Do I think we're going to see any massive price increases nationwide moving forward? No. But do I think we're going to see a huge price drop for housing? No. Just kind of muddling along here for the next couple of years.
Well, I want to pivot a little bit and talk about the markets. When you and I spoke earlier this year in Q1, we were talking about the concentration in the S&P 500, namely the Magnificent Seven, the tech names that all of us know and follow. And I, kind of looking back at that conversation, you and I were talking about the issues with that concentration, and maybe some of that would filter out and spread out to other, broaden out in the markets, and so to speak. Obviously, those 7 names have continued to lead the way. I think they now command over 40+% of the move in the S&P 500. So what are you seeing in that regard? Do you think we still have the chance of this broadening out, or do you think they're still going to lead the way?
Yeah, it has been interesting because every time it seems like we're seeing some broadening, all of a sudden it kind of reverts back to just the Mag 7, right? And if you look through the third quarter, just as you said, I mean, the Mag 7 accounted for 42% of the overall S&P 500 return. And just those Mag 7, those 7 companies make up 32% of the overall S&P 500, which is incredible to think about. I mean, they're just massive. Now, it's not to say they're not great companies. They are. But they've really been driving everything. And as we've just seen in the last couple of weeks, things can turn. And when things turn, a lot of these have gone up a lot. They can come down, I think, a lot as well. And I don't know if we're in a correction here or what we're dealing with here, but I think it's important more than ever to have a financial advisor. And the biggest reason is that you need to be disciplined. You need to have a diversified portfolio. So Are we seeing broadening? I don't think so. Not to the extent that we would hope to be seeing by now, but it is getting slightly better than where it's been. If you look at for the overall S&P 500, if you look at how many of companies within the S&P 500 are actually beating the overall index, think back to 2023. That was the worst that we had seen, going back to at least 2000, where we only saw about 27% of stocks within the S&P 500 outperform the overall S&P 500. Well, 2024 came around and things got a little bit better. We had 28% instead of 27% outperform. So we saw the ever so slightly a little bit more broadening through the third quarter this year. It's actually improved somewhat. It's about 37%. So better, but still nowhere close to 50% or more that are outperforming the S&P 500, anything close to that. So I would say we're seeing a tiny bit more broadening, but I would hope to expect to see a lot more in the future here as time goes on.
When regarding those companies, and there are some others that are emerging in the space, but artificial intelligence, right? It's been a hot topic, and I think even more so now as we're looking at the valuations on these companies and the hype or whatever you want to call it around AI. Some of that seems to be getting called into question. Although on the other hand, I look at the amount of money that these companies have on their balance sheets that they're spending towards AI. Give us an update. What are your thoughts on AI? Where do you think we're at in the life cycle? Do you think it's potentially some bubble territory where we might see some of this reset?
Yeah, I mean, I definitely think there's certain companies, more smaller companies that aren't really profitable that have just gone up hundreds, if not thousands of percent that I'd say are in bubble territory. But I think looking at the overall market in general, I'd say I wouldn't say we're in bubble territory. I would say the market's overvalued by almost any fundamental metric that you look at. So I would be more cautious here. AI is real, and the investments that are taking place are real investments. I know there's some new investments that are supposed to be taking place over the next couple of years through OpenAI that are basically promises for money that hopefully will be generated at some point, and who knows if those come to fruition. But the big companies that are making these investments today, it's real money that they're using today to make those investments. And if you look at, for instance, just investments in equipment and software, and information processing equipment, I mean, it's been almost astronomical, the amount of money that we're seeing flow into there. Just from a GDP perspective, information processing equipment and software from a business investment standpoint contributed as much to GDP over the first two quarters as consumption did for growth in GDP. And when you think about kind of, is that big or small? Well, consumption makes up 70% of the weighting for GDP. This category makes up only 4%, but it contributed as much as consumption to growth. That's pretty sizable when you think about the implications of what's going on in terms of business investment today. I think we're still in the early stages from a business investment standpoint of what we're seeing here. It's a real build out that's taking place. The biggest issue to me still is on the energy side. How are we going to be able to everything that is currently being constructed? But what I love about it is that we live in America, and that entrepreneur figures out a way to do it. And so I think we will figure out the way to do it. But it is an uphill battle moving forward here.
Yeah, we seem to find our way some way or other, right?
We do. We always do.
Yeah, it's the American spirit. Well, I know we've touched a little on the data points and kind of what things look like going forward, but let's lean into that a little more as we sort of wrap up and we'll head to questions. What do you think 2026 looks like? I mean, what do you think's on the horizon? Where do you think we're going economically and market-wise?
Yeah, I think it's going to be more of kind of the same of what we've seen this year, where we have an economy that's growing, but I think is showing some signs of cracking. That's not to say we're heading for a recession. I just think we're going to see a slower growth economy moving forward here into the next year. On top of that, when I look at the S&P 500 or the stock market in general, I still believe that things are overvalued here. Maybe we're in a correction today. I have no idea. We'll see, obviously, as time goes on. But I still believe the market's overvalued. And the way that I would view the market today is when I think about the way to sum it up, I really think back to a guy named Roy Amara. He was a a futurist. He passed away, I believe it was 2007. I think it was in the 1970s. He coined a term that I don't know if he said it was a Mars law or if somebody else said eventually it was a Mars law, but basically what he said is we tend to overestimate the effect of technology in the short run and underestimate the effect of technology in the long run. And when I look at AI today, I think that's exactly where we are. And when you look back at all these different periods of time where the market's gotten ahead of itself, I think a lot of it's with this new technology that comes online. We get so excited about it and we just overestimate the potential in the short run. And I think that's where we are. And it's not that AI is not going to completely change the world, because I think it already is, but it will in ways that we can't even fathom today because of the way that our brains think. We think in a linear fashion, and this is growing in an exponential fashion, and it's just so hard to be able to process it. So it's not that I don't think these companies are unbelievable companies and they're doing exceptionally well. I just think that the valuations have gotten a little bit ahead of themselves.
Sure. Just to add to that, I read a stat the other day that I believe it's 15% of Fortune 500 companies today are actually using AI. So to your point, I mean, the adoption and the application of AI to me seems to be in its early stages. And I think to your point, we don't really know what that world's going to look like. If AI is as powerful of a tool as we believe it is, then I agree with you. I think we're in the early innings.
Yeah. And what you said, I mean, 15% of Fortune 500 companies, those are the companies that are going to be adopting the quickest, right? So you think about small and medium-sized business, it hasn't even touched the potential there. And I really believe over the next 15, 20 years, everybody's going to be using AI in a way that makes them unbelievably more productive. But it's going to take time to filter through for companies to figure out the best way to use it. And in the short term, I'd say, yeah, be a little bit more cautious here, be very diversified. But in the long term, I really couldn't be more excited. I think it's going to change healthcare. It's going to change everything in a big way. And there's a lot to be excited about.
Yeah, I agree with you. Well, this has been fantastic. Thank you. Thank you for getting into these and giving us an update on things. I do want to get to a couple questions from the audience. One of the questions came in was surprises. What do you think could surprise us in 2026 or beyond that?
Well, probably the biggest surprise is that maybe Travis Kelce and Taylor Swift break up. They don't have their wedding. I'm just kidding.
We're not recommending a bet on that.
No, don't bet. Don't bet on that. I just think the biggest surprise could come from monetary policy. If all of a sudden the Fed decides to change their tune and that they believe that inflation is going to be a big issue, and all of a sudden they no longer decide to cut interest rates moving forward here, and all of a sudden people believe that they're moving in the opposite direction, to me that could have dramatic implications for not only the markets. I think we're already seeing some of that just from no rate cut or a possibility of no rate cut in December, but for the markets and the economy in general, I think the Fed does need to be cutting here moving forward here. And so if we see them all of a sudden, and I don't think that's likely, but I think that could be one of the biggest surprises if they do decide to do that. I think it will be very devastating for both the markets and the economy in the short term.
That definitely would be a shock. One other question came in talking about taxes. What do you think taxes are going to look like next year?
Yeah, I think they're going to be where they are or better than where they are today. The one big beautiful bill a lot of those new provisions in there, or even the old ones, will go back into effect or stay in effect. And that by itself will be a huge benefit. So when I look at everything that is happening with the one big beautiful bill that was passed and put together that with the tariffs that we've seen, and there's a chance that the tariffs are ruled unconstitutional, or I think a very good chance that they are. The administration has other ways to enforce tariffs as well, but I think they will get a little bit better from that perspective. So if you look at the benefits from the one big beautiful bill plus slightly lower tariffs, net, I think from a tax perspective, things actually get better, which is a positive for the economy.
That's great. Well, Strider, thank you so much again for coming on with us again. Like I said, I think it's been great to have a chance to talk about some of the things we highlighted in Q1. Obviously, some things have changed, some things haven't, but really appreciate you taking the time coming on with us today. And thank you all for joining in, listening. If you're not subscribed, please subscribe to us on YouTube, and have a happy holidays. Thanks everybody from Cottonwood, and appreciate it, Strider.
Thank you so much for having me. Wonderful to be with you again.